Are you maximizing the property you live in? On today's video, I'm going to be sharing a concept that when I understood this, it completely changed my mindset. If you're brand new to the channel, you know what to do. Hit the subscribe button, hit the bell so you get notifications. Drop me a comment, let me know what you think. Let's have a discussion. I'm active on there every single day. So before I get into this, little disclaimer. This isn't for everyone, and I don't want to make light of the equity in the property you own, okay? Please speak to a mortgage broker and a financial advisor before you touch any of your equity. But in today's video, I'm just going to share my thoughts, what me and my friends do, and I'm super surprised that more people don't do it because, on the whole, historically, you can't get much safer than bricks and mortar. The thing I love about property is it's got an address. It's going to be there tomorrow, okay? And generally, values go up and properties can provide cash flow if used correctly. So with that being said, a lot of you are in properties and you're paying down the debt. You might have done an extension or you've done a new kitchen, or over years you've added value to it. You might have had inheritance at some point and smashed some off the debt, and you're sat there, your mortgage payments are going down, which is great. But as your equity grows, there is an opportunity cost of leaving that money in one property. And my personal opinion is the property that you own and live in is a liability. It is not an asset. Nobody ever gets rich based on the house that they live in, okay? It's what you do in terms of investing and business to bring income in, not spend income. So the fact of the matter is a lot of you could be sat on properties with quite a lot of equity that you could be leveraging to improve your lives. And in today's video, I just want to go into a bit of detail on how you would know if this is you and what the steps you would take to try and tap into some of that hidden equity that you could get actually earning you money rather than costing it. If you've just brought a new build off plan, this may not apply to you because you've already brought at the top end. It could apply to you if you did it off plan and the market's shooting, so don't discount it. And also keep in mind that in order to do this, depending on the term you're in your mortgage, there may be early repayment charges. So once again, speak to your broker. So this is how we do it. I've broken it down right here and I'm going to run through the questions for you. Question number one, what is the current value of your property? And the best way to find this out is to look at comparables. If Sheila up the road just sold hers and got 220, maybe get a couple of estate agents out to come and officially value it for you. And let's say they come out and say, listen, you could get in between 190 grand and 220 for this in the current market. And you're thinking, wow, well, we paid 150 for it and we've only got 100 grand left. So there's some equity there. Question two is, what equity do you have? So if you check your latest mortgage statement, you should normally see, right, we've got 100 grand left to pay on this over the next 20 years. And by the way, the whole point of this is we don't want to have to wait 20 years to start living. We want to get financially independent today, not in 25 years. So you establish, value of the property is 200 grand. We only owe the bank 100K at the moment. That means you've got 100K equity right now. Number three, you need to look at what is your household income. Because on a residential mortgage or a mortgage that you live in, the affordability checks will be based on your earnings. So let's say you earn 25 grand, your spouse earns 25 grand, that's 50,000 pounds. Multiply that amount by 4.5 and that will give you your approximate lendability. That doesn't take into account that flashy lease car you've got or any loans you've got. But if you're loan free, then they would probably lend you 50,000 times 4.5, which is 225 grand. I hope you're still with me. Next step is then seeing what the difference is between the value and the equity. So what happens is on a residential mortgage, usually the banks will be willing to lend or, borrow you 85% loan to value. So what that means is 200 grand purchase price, 15% is 30,000. So they'd be willing to lend you £170,000 against that house. So let me break it down for you. This is you. This is the existing lender. Let's say this is the new lender, right? The new lender comes out, values your property, says it's worth 200 grand, you earn 50K, we'll pay you £170,000. Okay, they'll pay you 170. Then you would go to the existing lender and say, right, how much do I owe you? 100 grand. You pay them 100 grand. You still own the house. But then the magic thing is you've now released £70,000 worth of equity. And that's money that before was just sat there doing nothing. You're already going to benefit from the appreciation of the house because you own it, anything above the loan. So now you've got 70K to go shopping, not Selfridges. I'm talking about in investments that can provide income for you and your family. Now, when you do borrow more, naturally, the mortgage payments are going to go up, okay? But as long as you can utilize the 70K to make more money than that, and you will, then what you've done is you've managed to create more equity, and you're going to end up owning maybe 2 properties instead of just the one. So you'll benefit from 2 lots of capital appreciation. And the holy grail is this property will pay for the house you live in's mortgage, and then you've essentially become mortgage free right now. So in layman's terms, the new valuer is willing to lend you more based on the higher value of the property because of you repaying the debt, because you've sat on it, because you've actually refurbed it. And with that money, you're able to pay off the old lender, and what the difference is yours. Okay, it's as simple as that. And as long as you do smart stuff with that money, you can seriously use it to leverage your situation and improve your family's life. Once again, get financial advice, but personally, I think it's a game changer, and I think a lot of you could really improve your financial independence and fast track your journeys. Hope you find this useful. Any questions, comment below, and remember, don't wait 25 years. Get creative.